Today, while this video series 103, we have been discussing the types of borrowers part 1, and the reference to this video is JAIIB paper 2 Principles and Practices of Banking, Module B, Functions of Bank, Unit 22. We shall be discussing various credit lending topics based on JAIIB and CAIIB latest syllabus through small videos. It is certain that those who read and understand the topics covered in the videos will find it very easy to appear in the JAIIB and CAIIB exams and also in the DBF examination. The founder of this channel is a retired banker with 36 years of experience. He had served 2 banks for 28 years. He also served as a senior faculty and consultant with a reputed bankers training college for 8 years, teaching mainly the lending topics starting from basics of lending to advanced credit management. He still continues to be a freelance trainer in banking subjects. Today what we are going to discuss is the types of borrowers, and the types of borrowers can be divided into individual, proprietorship firm, trusts, cooperative societies, statutory corporations, partnership firms, companies, Hindu undivided family, and limited liability partnerships. Individuals are further divided into minor, persons with not of sound mind, disqualified person, married woman, Pardhanashini woman, illiterate persons. Let us first discuss the minor individual. A minor is not capable of entering into a contract, and a contract entered into by a minor is void. The only exception recognized is of supply of necessities to him. Section 68 of the Indian Contract Act says that the property of a minor is liable for such loans. Guardians may borrow on behalf of the minors. Second one is not of sound mind. If a person is not of a sound mind, then he is incompetent to enter into a contract as per section 12 of the Indian Contract Act 1872. A person will be considered not of sound mind if at the time when he makes the contract he is not capable of understanding it. So a contract would be invalid if it is proved that the borrower when entering into was not in sound state of mind and could not understand what he was doing and the implications of entering into a contract. The third one is the disqualified person. There may be statutory disqualifications imposed on a person in respect of her capacity to contract. For example, a person declared as insolvent cannot enter into a contract so long as she continues to be a non-discharged insolvent. The contract entered into by such a person is not enforceable as per section 11 of the Indian Contract Act. Married woman. Law does not debar a married woman to seek advance from a bank. She must have independent means and borrowing should be commensurate with her requirements and her ability to repay. Her husband will not be liable for her borrowings except when he has joined as a co-borrower or guarantor. Pardhanashin woman. Pardhanashin is one who observes seclusion in accordance with the customs of her community. She is qualified to get an advance sanction and has a capacity to enter into a contract. Practical difficulties may arise at all stages of lending in ensuring the identity of the borrower woman. Illiterate persons. An illiterate person has a capacity to enter into a contract. He or she executes the documents by thumb impression. If both hands are lost, foot or toe thumb impression is affixed and considered as a mark. The document should be read out in the presence of a witness whose name and address should be kept on record. Proprietorship form. This is a business concern wholly owned by an individual. As such, dealings with the proprietorship firms are similar to dealing with the owner individual. Like individuals, the dealings with the proprietorship firms are governed by the Indian Contract Act. In accounting, the business is treated as distinct and separate from its owners. This principle is followed to avoid mixing up business transactions of the firm with the personal transactions of the owner. The liability of the sole proprietor is unlimited. The creditors will have recourse not only against the assets employed in business but also against the private assets of the proprietor. Trusts. These are governed by the Indian Trust Act 1992. There are private trust and public trust. If they are public trust of Hindus, Religious and Charitable Endowment Act will be applicable. If they are public trust of Muslims, they are governed by Waqf Act. Trustees. Trustees manage trusts. The powers and duties of trustees are provided in trust deed and are also regulated by the respective laws applicable to such trust. For example, in case of public trust, charity commissioners or commissioner of endowment have the powers to supervise the activities of the trust. The trustees of the Muslim Waqf is called Mutawali and his conduct and functions are regulated by the Waqf board. Therefore, a banker dealing with a trust should ensure that all the permission required for taking a loan is obtained from respective government authorities. Banks may consider taking the following indicative list of documents while opening trust accounts: registration certificate, trust deed, permanent account number or Form 60 of the trust, documents relating to beneficial owner, managers, officers or employees as the case may be, holding an attorney to transact on its behalf. Clubs, societies, schools and other non-trading associations. Such bodies, if not incorporated under the law governing them, cannot enter into any transactions. These bodies are usually governed by the Companies Act or Cooperative Societies Act and functions between the ambit of those laws. For example, clubs can be registered under the Companies Act 2013 or under the Societies Registration Act or the Cooperative Societies Act. In the case of lending to those bodies, a banker should study the bylaws, rules and regulations applicable to them and ascertain the legality of lending to them. Statutory corporations. There may be corporations established by an Act of Parliament. These are called statutory corporations. For example, State Bank of India is established under the State Bank of India Act 1955. Nationalized banks are established under the Banking Companies Acquisition and Transfer of Undertaking Act 1970 and 1980. These statutory corporations are governed by such acts. Having dealt with the part 1 of the types of borrowers, subscribe to my channel which is totally free of cost. Subscriptions will give you intimation on the new videos published. More videos based on JAIB and CAIB syllabus based credit lending topics are to be published. Thank you very much. My YouTube channel name is NPIS Learning Modules on Lending.